So you're in your early or mid 20s and you might have finished college, you're maybe even still in college. You're working and you've been thinking about investing, or maybe you've been dabbling in investing, but it's still confusing and you're like, Giovanni, help me out. I have no idea what I'm doing. So that's why today I'm going to talk to you about how I started investing in my early 20s and what I would have done differently now looking back. You might also be thinking about, should I save my money? Should I pay off my debt? Like, why do I need to start investing in my early 20s? I want to focus on buying a car. I want to focus on buying a house. Well, starting in your early 20s, that's a great time to start because you still have so much time on your side to make mistakes and get back up, learn from your mistakes, and you have all this time on your side to build wealth. The earlier you start investing, the better. So I started investing at the age of 21. I was new to the US. I think I was in the US for about a year. And the second company that I worked at, they offered a 401k to their employees. And I didn't know what a 401k was. So I'm like, okay, let me just go to the local library, which is what I did. And I got a couple of books on investing and stock market investing to be exact. And in one of those books, there was a chapter on the benefits of a 401k. One of those benefits, of course, being the company match, which is a company matches a certain percentage of what you're investing in your 401k. So after reading it, I'm like, okay, this is pretty interesting. Let me just go ahead and start investing in my 401k. And the options were pretty limited with the 401k, but I did invest in an index fund, which was the S&P 500 index fund. And to this day, that's still a index fund that I invest in. After about a year or two, I opened a Roth IRA account with a company called Scottrade. Now, Scottrade doesn't exist anymore. They got bought out, but I do remember that every time when I tried to execute a trade, I had to pay $6.95, which is crazy because nowadays you don't even pay a commission fee for executing trades. Now, you can have multiple accounts open. So if you have a 401k, yes, you can still open up a Roth IRA or a IRA account. Also, you can also open a traditional brokerage account. So when I was invested in the Roth IRA, there is something that I did notice. After I logged into my account after about a year or two, because I wasn't checking it every single day, but after about 2 years, I logged into my account and I noticed that my money grew, of course. I saw my capital gain. But there was another thing that I noticed, which was a dividend. So with me investing in the S&P 500 index fund, I did notice that I was getting a dividend on a quarterly basis. And back then I was like, okay, what's a dividend? So when I looked at the dividend, I also noticed that my dividend got reinvested to buy more shares or partial shares in that S&P 500 index fund. This sparked my interest into dividend investing. So at this time, the only thing I did was invest in an index fund. I never invested in a mutual fund, and because of the fees. And then after I learned about dividends, that's when I started doing more research on dividend paying stocks. Went to the library, got a couple of books, and also went online this time, learned a little bit more about dividend investing. And in my Roth IRA account, I sold all my shares in the index fund. I was still investing in the index fund through my 401k, but I decided to use my Roth IRA as a account to experiment with buying individual stocks in dividend paying companies, of course. After about a year or two, I opened up two traditional brokerage accounts, one with Ally, which still exists today to this day, and one with Capital One Investing, which does not exist anymore. Now, keep in mind, I didn't have a lot of money to invest back then, so it wasn't like I was investing tons and tons of money. And that's something that I also tell to people. You don't need to have a lot of money to start investing. Even if you want to buy an individual company or an individual company stock, you can start by investing even in a fraction of a share. Back when I was investing, you had to buy at least one share, but now you can get away with just buying a fraction of a share. And if that company pays a dividend, you'll also get a fraction of the dividend. So if I had to look back and try to figure out what I would have done differently, is definitely I would have invested more. Because even though I was investing, there were a lot of times where I just took like one lump sum, invested it, and just left it. And then I logged into my account like a year or two later, and then I was like, oh wow, I should have invested more. Another thing that I would have done also is do more research on different index funds. Like right now, I like to focus on buying individual stocks in different companies. But back then, definitely should have looked at researching more index funds and not only focus on the S&P 500 index fund. So let's shift gear and look at an article by The Motley Fool. And the title of the article is Investing in Your 20s, Three ETFs to Watch. Now, that's interesting because even when I started investing in my early 20s, I was just focusing on index funds. I never paid attention to ETFs. With ETFs and index funds are similar, but the fees, that's where things are different. So with an index fund like the S&P 500 index fund from Vanguard, the minimum investment is $3,000, but with an ETF, you don't have to pay that much to buy a specific ETF. So let's get into this article. So investing in your 20s, three ETFs to watch. In today's age, exchange traded funds are a useful tool for investors looking to get their feet wet in the market. So that's perfect for if you're new to investing and you don't want to focus on picking individual stocks. You want to have a diversified portfolio and not have to worry about, okay, what is my stock doing today? Okay, what stock B doing tomorrow? You don't have to worry about all that. You can just go on with your life. If you are in your 20s and just starting to populate your investment portfolio, you are likely discovering that you have lots of options, which was an issue for me also when I started out because I'm like, okay, there's so much going on. You got mutual funds, you got bonds, you got index funds, you got individual stocks, you got options. There's so many different options. One consideration that can help narrow things down a bit, while still being beneficial, is to look into exchange traded funds. These are easily traded specialty funds that track certain groups of stocks based on a specific criteria. So, with an index fund and especially like an S&P 500 index fund, what that actually means is that the S&P 500 index fund, it mirrors whatever it's tracking, and in this case it's tracking the S&P 500, which are the 500 biggest companies in the US. Let's just skip. While an ETF helps to focus your investment options, it doesn't mean you still don't have choices to make. With that in mind, here are three ETFs that 20 somethings might want to consider to find out more about. So this is going to be pretty interesting because I'm like, okay, what looking at what I did, let me see what they recommend. So the first one is the awesome Vanguard S&P 500 ETF, keeping up with the market. So I bought the S&P 500 index fund, but they recommend the S&P 500 ETF from the same company, Vanguard. So I'm already like bigging that up. As much as we may like to think we're going to beat the market with every one of our investment picks, that's pretty tough to do. For someone in their 20s, it can be easily true, as young investors likely don't have a lot of experience picking great companies to invest in just yet. To make sure that at least part of your portfolio keeps in tune with the broader market, you might want to consider an ETF that tracks the S&P 500. And definitely that's something that I also recommend. So even though I invest in individual stocks, I still have my Vanguard S&P 500 index fund that I'm still invested in to this day, and I'm still adding more money to invest in buying more shares in that particular fund. So it talks a little bit about some of the companies in the S&P 500 index fund, with Apple owning the largest weight, which is 6.4%, and it has an expense ratio of 0.03%. That was a big deal to me. Whenever I was looking at buying a mutual fund, I was looking at the fees, the management fees, the expense ratio, And then I looked at the index fund and I noticed that the index fund had a lower fee. And I'm like, okay, I'm just gonna go with the index fund. Let's see how it works. If it doesn't work out, I can always buy a mutual fund. This ETF offers a non-complicated way to get involved in the stock market. If you're younger and still learning about investing, an index following the broader market is a way to learn. You gain exposure to all the names you can think of while achieving a broader diversification. And along with the price performance, the Vanguard S&P 500 ETF also pays a quarterly dividend that carries a dividend yield of 1.67%. So like I said earlier, that's how I got introduced into dividends with my S&P 500 index fund. And of course, if you have the ETF, you'll also notice that you will get paid a quarterly dividend. And I have to say that this dividend will get reinvested into buying more shares or fractional shares in that fund. So number two, let's see what number two is. Swap US Dividend Equity ETF. There you go. Dividends are king. So they're pretty much in line with what I did. Like they look at it from a ETF standpoint. So like I focused on the index fund first, and then I started focusing on individual companies. But number two is a dividend fund, but it's a ETF. So you're getting a basket of dividends. So you don't have to go out there and pick and choose individual companies that pay a dividend. With this fund, you will automatically have diversification in dividend paying stocks, companies. Any investment portfolio worth its salt has a portion of it allocated to dividend stocks, of course. The lessons preached on power of compound interest over time are almost exhausting. However, it's one of the most important lessons someone in their 20s can learn. So it also talks about the dividend aristocrat. So the fund includes plenty of dividend aristocrats, companies that have raised their yearly dividend payout for at least 25 consecutive years, like 3M, PepsiCo, and Coca-Cola. That's pretty interesting because when I look at buying individual companies, one of my criteria is they need to have paid a dividend, an increasing dividend for at least 10 years. And 3M, PepsiCo, and Coca-Cola, all three of those companies are on my watch list, and I own shares in all three of them. So this one sports a healthy 3.2% dividend yield. That is pretty good. The ETF is a good cheap play with a management fee of just 0.06%, which is also really good. And let's just skip to number three. So number three, interesting. Vanguard Mega Cap 300 Growth Index Fund. Looking for growth. I can see that. Like I don't necessarily like growth stocks, so I'm more of a value investor. I like the income part of things, but definitely when you're in your 20s, you want to experiment. You want to see what you gravitate towards. You might like income or you might like growth funds, growth stocks. Growth stocks have the potential to gain in value fast. Growth stocks are usually tech companies like your Apple, Netflix, Facebook. So there we go. So this fund is investing in Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google. Of course, this ETF doesn't invest solely in tech. The objective is to follow mega capitalization growth stocks from the CRSP US Mega Cap Growth Index. The tech stocks make up 37.12% of the fund, but 19.11 of the fund is going toward consumer cyclical companies. Okay, let's just go. What else is there? Just go to the end. To the end, this is a good fund for someone in their 20s to maintain exposure to the industry showing the most promise right now. And I think that's about it. So, pretty good article. One thing that I would add is that so they do recommend a S&P 500 index fund. and they also recommend the dividend, not an index fund, ETF. So S&P 500 ETF, the dividend ETF, and then the growth ETF, which is actually really good because looking back, that's something that I should have paid attention to growth stocks, which I did not. One thing to me that's missing, but that's not something that you have to do in your early 20s. But one thing that is missing is a bond fund. And you could just not invest a lot in it, just a little bit, in a fund that invests in the global market. So not only in the US, because I think these three were mostly focused on the US, and we can take a peek at which companies they focused on. But I would add those two, a bond fund, and then also a fund that, or an ETF in this case, that invests in the global market outside of the US.